What's going on, everyone? Lilith here. When people talk about retiring early, the FIRE movement, being financially free, it all comes from the fact that active income isn't needed to cover day-to-day expenses, but rather it's taken care of through passive income. There are loads of ways of making passive income, but for today, we'll be sticking with saying that when you have a certain amount of money, you'll be getting some certain amount of percentage or some specific dollar amount based on your investment back to you every single period, whether that's a week, a month, etc. Traditionally, the stock market is where this income comes from, whether that's investments into index funds, mutual funds, individual stocks, etc. The income is usually distributed in the form of dividends. Similar to the stock market, you have the cryptocurrency market. And as we have dividends in the stock market, you have staking rewards in the cryptocurrency market. Regarding dividends, there's a super popular strategy known as Dividend Growth Investing, DGI for short. And so today, we'll be covering DGI in the stock market versus staking rewards in the cryptocurrency market. We'll be going over definitions, long-term analysis comparisons, and more, but feel free to check out the timestamps in the description. But with that, on the channel, we talk about stocks, credit, crypto, and this video is one of those crossovers between the stock market and the cryptocurrency markets. I'm super excited, but with that, I'll see you on the other side. All right. So starting off with dividends. Overall, dividends are nothing but you giving your money to a company, in this case, in the stock market, for this example, and basically you're giving some money and they're using that money to make more money, and as a thank you, quote unquote, they give you back some of that money, in this case called a dividend. A dividend comes from the stock price. So if a share, let's say of AT&T, is essentially $27.79, you're getting 7.36% a year. And what that equates to is annual payout of $2.08, which you divided by 4 is roughly 52 cents, says it over here. And they're paying you quarterly every 3 months. And they've been growing this dividend for 20 years. And for the last 5 years, they've been increasing that dividend by 2.09%. And so where this dividend comes from is essentially it's paying you back. So if it's $27.79 and let's say it's the dividend payment date, 52 cents from this $27.79 would be paid out to you in terms of cash, and you would still own one share of AT&T. The dividend is based on the stock price in terms of the percentage that it says it pays out. And so for the sake of example, we'll say that T, aka AT&T, pays 7% in dividend every year. And so looking at the graph, basically we have this max graph, and over here it shows 1990 as the earliest point in the graph. And you have that it goes $28.45 in the year 97. And the current price is $27.81. And so throughout the years, more or less, it's been pretty cyclical / has its ups and downs. And T is stuck kind of in that range of low 20s all the way to around 40. And so if you see this, it's around 53, highs over here, 47s, highs of 40s, and you have lows of 23s, low 20s over here, mid 20s, and here we are today at 27.81. So the point of the story here is, with T taking this example, it's one of the most popular and most famous stocks for DGI, Dividend Growth Investing. And I'm using it as an example because it's kind of the most famous one. And so the assumption here is you have a high dividend payout in terms of per year. So coming back here, you have 7.36%. You have a growth rate of 2.09%, and with inflation being around 2 to 3% every year, it kind of is matching inflation, we could say, at least in these last 5 years as it's grown its dividend. And it's been growing the dividend for 20 years. So what does this part mean, dividend growth? So if we look at the dividend history, over here, this is the last 5 years. And if you go to the all-time graph, it's more apparent. But here you have it. Starts off at around 19.54 pennies each quarter, and then it goes up, and today we're at 52 cents. And so back here, 19 is roughly 20, and 52 cents is roughly 2.5 times that. So the dividend has increased 2.5 fold, where in 1995, if you had put some amount of money, whatever that is, in one share of AT&T, the dividend you'd be getting is 2.5 times that from back then. And so the absolute number has gone up over time, and that's where the dividend growth comes in. On the other hand, the stock can go wherever it goes, but if the dividend keeps increasing, that's pretty much what we're looking at, the dividend growth. I want to toggle over to a similar example and use MSFT, aka Microsoft. So you have 1% dividend over here, and you have 17 years of growing that dividend. But in the last 5 years, compared to 2% for T, you have 10.45% over the last 5 years in terms of growth rate, which is also CAGR, compounded annual growth rate. So it's not just simple interest of 10.45, but this is compounding. And so looking at the dividend history for Microsoft, you see that this all time, it paid a huge dividend over here, and it says other, so this could be a special dividend, this is an exception case. But the S over here is a stock split, but the point is regarding dividends, over here, it is clearly upticking, and more so in the last recent past per se. And coming to the summary to see the all-time graph, I think is where we get some clarity, where even though it's a lower dividend in general and a high growth in terms of dividend, look at this graph. It's exponential. It's insane. And so why I pointed out T and MSFT here is there's always a concept in DGI, in dividend growth investing, between the stocks like T, where they don't grow as much, but their dividend off the bat is super high relative to the stock market in general, where MSFT, on the other hand, and cases like Apple, they pay dividends and they have a good track record of dividend growth and dividend growth history, but their stocks are also exponential in terms of their stock price. But the dividend you start with is going to be far, far lower. The point of all this regarding dividends, dividend growth investing, is that dividends indeed is another source of income in terms of passive source of income or income in general. And it could mean retirement. It could mean some type of slush fund. It could mean, taking care of everything. So this income could mean everything. It could just be one source. It's what you want to make it. And so the point is not just a source of income, but it grows exponentially with time. And that's the key concept over here, where dividend growth investing isn't about this year or the next, or maybe even 5 years from now, depending on the stock. But with compounding, just like compound interest, your cash flow can go to the moon. And with that crypto kind of pun segue, you have coming over here to staking rewards. So staking rewards, there's two types of concepts that are important to understand. You have proof of work and proof of stake. And so staking rewards are similar to dividends, where with dividends, you're giving your money, let's say, to the company to do whatever work they do, and based on profit and their accounting, they will pay you back some agreed upon percentage from their board, management team, shareholders, etc. Now coming to staking rewards, proof of work is basically, and I like to use the analogy of being an employee versus being the business. So when you're a shareholder of your T, your Microsoft, etc., you're a shareholder. You're not really working for it, but you are, because your money is working for you in order to get that dividend. Now, in staking rewards, you have proof of work, which is essentially working for that compensation. So for Bitcoin, for the blockchain and each block, for all the multiple calculations done by miners to mine certain Bitcoin, their computers are working and then getting compensated when they get through that block in Bitcoin. And now on the other end, you have certain coins that do actually pay you out staking rewards. And it's a bit different, but you have proof of stake. And so proof of stake is saying that, hey, I'm not going to work as an employee in terms of proof of work, but I already own a stake. And based on owning a stake, I'll be compensated accordingly. And so what this means is when you own this proof of stake, so for example, if I have some Tezos, then over here, basically, I have some stake in the actual coin itself for not just the current state in terms of foundation of where the cryptocurrency can go or a particular coin can go in the long term, but it's basically saying that, hey, I'm providing this foundation of stability and to some degree liquidity, depending on which way you look at it. But overall, Tezos over here, I don't have a big position. This is my Coinbase account. And so specifically over here, you have estimated reward of 4.63%. And so we can consider that as the dividend yield in terms of annual payout. And so 4.63% is roughly, let's say, 5%. And I don't do math or calculations like this, but it's important. I'm just going to keep it more simple for this video. So 5% over here. And look at the frequency. When we talk about dividends, we have dividends that are paying out usually quarterly is normal. There's some that are semi-annual, and you have monthly payers as well. So every month you'd be getting a dividend payout. And so the yield would be the same per year, but you just get 12 paychecks, quote unquote, versus 4, which is every 3 months. So here we have some assumptions that are made, but I've taken T stock for the figures that you see on screen. And so you have a dividend calculator, and so you're starting at $100. You're going to contribute 100 every month, so annual contribution is 1,200. And this is just a real example that anyone can replicate. The numbers aren't perfect, but at the same time, it kind of shows like, hey, there's this progression and it's possible, and this is how to do it. So you have 7% in terms of annual dividend. You got 2% annual dividend increase per year. The 5-year growth rate on Seeking Alpha was 2% and change, but this may not be consistent for the long term, and we're also using history to base our future predictions. So just a kind of disclaimer of sorts for that. So you have 7% rounded for annual dividend, 2% growth. The share price, aka the stock price, it didn't really move. It's kind of cyclical, but not really. And so I just put 0% for the long term, just because the focus for many folks that are in DGI, dividend growth investing, is to use T kind of in their retirement or otherwise to make sure that they're getting a high payout for the amount of capital they've invested. And so 20 years investment time frame. And so this is case number 1. And now we have case number 2, where I've inputted it for Microsoft. You have 1% annual dividend yield, 10% growth rate. Of course, for 20 years, can Microsoft grow their dividend at 10% for 20 years? Maybe, maybe not. But the point is, for example, and the share price, the S&P 500 goes up 7 to 8% every single year. And so I put 10% because my assumption is tech, FANG in general, Facebook, Apple, Amazon, Netflix, Google, etc., would be growing faster than the market. And just an assumption here. And just to point it out, DRIP over here, dividend reinvestment plan, is basically saying, hey, whatever dividends you receive, do you just reinvest it into the same stock? And so finally, we have our friend Tezos, where I took annual dividend yield of 5%, rounded off, and your annual dividend increase, I remained it as 0. And I put it as 0 because specifically, there's something with staking rewards where the whole point is also to kind of beat inflation as more coins are existing in the network / on the platform in general. So won't get too detailed into that, but the math is basically no increase here, same yield, but expected annual share price appreciation. So 5%, and this is just an estimate. This is not real numbers because going back to Coinbase, and if you look at Tezos in general of the graph, all-time graph, of course, it had its huge spike up here up to $10 December 17th and has been kind of all over the place. But I want to speak for the long-term sake here. So in the long term, I'll just say 5% and just an estimate, but you can plug in your own numbers. So I'll leave a link to this dividend calculator below in the description. Coming back over here now, numbers reveal time, right? So for T, we scroll down. All of it is exponential just because of the way it's been the growth rate, right? So dividend income, it kind of is, all right, it's somewhat linear gradient wise, but there is this exponential curve over here. And so the final number you have is 61,605 and 15 pennies. And this is after investing over here for 20 years and at $100, aka $1,200 a year. So we're saying 24,000 of our own money is bringing us $61,605, aka almost like 2.5 times around that area. And the estimates are important here because all of these are estimates, but I think that I just want to take the point home where you yourself can plug in your own numbers, whether it's for dividends, for staking rewards, for whatever you want. And that's kind of the point of this video. And so I just want to share this kind of thing that I've been doing. It's like a fun experiment. So now coming down to Microsoft, so we had 61,000 for T. And over here, look at this. You got an ending balance of $103,441. And so the annual dividend income is $7,000 roughly, $69.59 specifically. But over here, you have $64.07 for T. So it's almost similar, but definitely there's a big difference in terms of the overall portfolio balance. And that's coming to basically the growth rate of Microsoft. Because you have that almost 10% every year for 20 years, of course, it's going to be a lot more with time and naturally with the dividend as well. So we started off lower, but then it ends up almost the same, if not higher, after 20 years. And now, DGI versus staking rewards at a high level, you have Tezos, bringing us in at 69,402 and 75 cents. And so this is based on the fact that there's no dividend increase, but it's also 5% in terms of dividend, but also 5% in terms of growth. So it's kind of in that middle area where it's not maybe high growth, but it's also definitely not a high payer and slow growth. So with that, your annual dividend income is coming to 3,470, so around half of 7,000. And so yeah, it's a good insight, good to know. So overall, feel free to plug in your own numbers. Again, I'll leave it in the description below. But the exercise was basically saying, is it better to be a dividend growth investor in the stock market or staking rewards in cryptocurrency? So the math just depends where you're putting your money. And if you consider this personal finance, then to every person, it's their own kind of decision and choice and mentality and ideology overall. So in my opinion, if you're interested in both, definitely just diversify, right? But I just want to talk about the pros and cons here while we have some little more time before I take up too much of your time. So thank you for staying here till the end. So I think the pros of staking rewards is basically you have diversity in terms of investment. You have a different asset class. You're not just into the stock market. You're not just into the cryptocurrency market. And so with that, what that really means is you have more of safety of sorts, right? Because there's this feeling of, okay, oh man, the US dollar, it's gonna crash with everything that's going on in 2020 and the Rona, or something else may happen and something else over there. And the world is always feeling in this turmoil and currency battles and wars, etc. And so having this diversity of asset class where cryptocurrency can go across borders, go international, there's so many other use cases, and the way the technology is in the back end can influence a lot for the future. And so there's more than just kind of the money aspect, but you have that proof of stake, you have that stakeholdership in, for example, a Tezos or other coins that pay staking rewards. And so it's not just working to get that income, but you actually have a position in kind of the future, which can have even more compounding returns, more than just money. So that's a pro, just being involved in that diversity of asset class. But coming to a con of staking rewards, and it depends on which lens you're looking at it through. So for example, if you're looking at Tezos, you're going to get more Tezos. If you're looking at other coins, you're going to get more of the same coin. Now, if you look at dividend growth investing or the stock market, fiat is based in US dollars, and I'm speaking specifically to the US stock market, but in general, the world works off of the US dollar in general. So the point is, with DGI or the stock market, you're getting paid out in cash, and you're getting that US dollar that's very flexible that you can buy other stocks with, buy maybe cryptocurrency with, go do anything else you do with it because it's flexible. On the other hand, you have staking rewards, which it's not that it's not flexible, you have more of the same coin, and that's great. But just like any system can collapse, similar to the previous reasoning, you have US dollar versus this particular coin versus another coin versus another coin, and you can have a lot of the same thing, but if that coin is worth nothing, you'll have a lot of nothing. With DGI, on the other hand, you have at least cash, where you're basically extracting the share price over the many years. So all else equal, if T goes to zero, at least at 7%, 14 times 7 is roughly 98. So it's almost 100%. In that many years, you would get your money back. Is that the most exciting thing to hear? No. But at the same time, at least you know that, hey, what I paid up front, I am going to get it back. And that all comes back to how fast you want your money to grow, risk versus reward, etc., etc. Finally, I think it's a great decision to obviously invest in both. Not a financial advisor, you know how it is. But overall, play with it. Leave some comments below. Like, share, subscribe. You know how it is. But we'll see you soon enough. I hope this video was enjoyable, or at least some valuable information was given, because this is one of those questions that I always was thinking about casually. And I was like, all right, let's make a video about it. So anyways, thank you so much. We'll cue the outro now. We'll see you soon enough. Peace.